Hi there, it's Friday the 5th of July 2019. I'm Steve Towers. Welcome to ITB. Let's get started. In regard to digital taxation, only two developments to note this week, both being totally expected. The first is that France's lower house of parliament, the National Assembly, has now passed the compromise bill for the digital services tax. You'll remember that the compromise bill was agreed last week by the joint committee from the two houses. The bill will now be voted on by the Senate on the 11th of July. And the second is that the G20 leaders at their summit in Osaka last weekend endorsed the Inclusive Framework's program of work on digitalisation. The EU has announced two major developments in regard to trade agreements. The first is a political agreement for a trade agreement with Mercosur, a bloc comprising Argentina, Brazil, Paraguay and Uruguay. For a copy of the European Commission's press release, please go to our website or app. And the second is the signing of a free trade agreement with Vietnam, which will eliminate 99% of customs duties on goods from both sides. An investment protection agreement was also signed. For a copy of the joint press statement from the two parties, please go to our website or app. You'll remember that in January this year, the European Commission announced that it had decided to launch an in-depth state aid investigation of tax rulings granted by the Netherlands to the Nike Group. Well, the Commission has now released the non-confidential version of that decision. There are several different structures which are considered in the decision. However, this structure provides a good illustration. Nike Inc. is the US parent company of the group. Nike International Limited, or NIL, is a subsidiary company within the group and is incorporated in Bermuda. Nike Europe Operations Netherlands BV, or NEON, is also a subsidiary company within the group and is incorporated and tax resident in the Netherlands. Nike Inc. and NIL entered into a cost-sharing agreement to develop IP. Under that agreement, NIL is the owner of Nike trademarks, trade names and patents for all non-US markets, with some exceptions in East Asia. NIL has no employees, but a certain number of Nike Inc. headquarter employees based in the US have been appointed as authorised managers of NIL to run its day-to-day business. NEON is the sales and distribution principal and regional headquarters of the Nike Group in the EMEA region. Its activities comprise product design, sales management, pricing and discount policies, inventory management, customer services, marketing management including market research, local advertising and promotion, including athlete sponsorship and endorsement contracts within the EMEA region. NIL granted to NEON an exclusive license to use the Nike IP in EMEA. Under the license, NEON pays an annual royalty to NIL, which is calculated as the difference between the operating profit of NEON and 2 to 5% of its total revenue. In other words, the royalty is set such that it leaves Neon with a post-royalty operating profit of 2 to 5% of its total revenue. That annual royalty was supported by an APA issued by the Netherlands tax authorities. That APA used TNMM with Neon as the tested party. The European Commission has formed the preliminary view that the APA constitutes illegal state aid on the basis that the royalty calculation does not satisfy the arm's length principle. It leaves Neon with taxable profits that are lower than would be the case if Neon and NIL were dealing at arm's length. Let me take you through the various arguments which the Commission is using to support its preliminary view. The first argument relates to the APA's use of Neon as the tested party. First and foremost, the Commission takes the provisional view that the Dutch tax administration was wrong to endorse the premise that Neon performed routine distribution functions. Instead, the information supporting the APA requests should have led the Dutch tax administration to conclude that Neon performed more unique and valuable functions in relation to the Nike EMEA IP than the functions performed by NIL. Assuming the absence of any comparable uncontrolled transactions to price the Neon license agreement, the Commission provisionally considers that only a transfer pricing arrangement based on the TNMM with NIL as tested party could have led to a reliable approximation of market-based outcome for the intra-group transaction. Since applying the TNMM to NIL instead of Neon would result in a lower annual royalty payment than the transfer pricing arrangement endorsed by the contested APA, the Commission provisionally concludes that the Dutch tax administration conferred an advantage on Neon by improperly reducing its taxable base in the Netherlands. The Commission's second argument relates to the use of TNMM instead of profit split. The Commission has doubts that the TNMM was in fact the most reliable transfer pricing method to price the Neon license agreement. Assuming no comparable uncontrolled transactions exist with which to perform a CUP analysis, and further assuming that NIL could also be considered to perform unique and valuable functions, a transfer pricing arrangement based on the profit split method would have been more appropriate to price the Neon license agreement than the TNMM. The application of the profit split method leads to a portion of the residual profit from the Neon license agreement being attributed to Neon, instead of the totality of that profit being attributed to NIL. That translates into a lower annual royalty payment and thus a higher taxable base for Neon in the Netherlands. And the Commission's third argument relates to the profit level indicator. Even assuming that the TNMM was the most appropriate transfer pricing method to price the Neon license agreement, and further assuming that Neon was correctly chosen as the tested party for the application of the TNMM, the Commission has doubts regarding the profit level indicator chosen. Under the contested APAs, the profit level indicator for the allocation of profit to Neon is an operating margin on total revenues. Neon's total revenues derive not only from its principal headquarter activity in the EMEA region, but also from the sub-licensing to third parties and other group companies, of non-EMIR IP, which Neon holds via a royalty-free license agreement with another group company. The Commission takes the provisional view that by including revenue derived from the sub-licensing of IP outside the EMIR region in the base to which the profit level indicator is applied, the contested APAs artificially inflate the level of the annual royalty payment, which in turn reduces Neon's taxable base for Dutch corporation tax purposes. For a copy of the Commission's document, please go to our website or app. In Australia, the tax authorities have issued guidance on the interaction of the transfer pricing rules and the debt equity characterisation rules. This guidance was originally issued in draft form last year. The guidance indicates that the transfer pricing rules operate first. If the effect of their operation is that arm's length conditions are deemed to apply, then the debt equity characterisation rules are applied to those deemed arm's length conditions. For a copy of the guidance, please go to our website or app. In Malaysia, the government has published the earnings stripping rules, which are effective the 1st of July 2019. These rules were first announced in the country's 2018 budget in October 2017. The rules limit the deductibility of interest in related party transactions to 20% of tax EBITDA. For a copy of the rules, please go to our website or app. In Taiwan, the government has issued a decree on the meaning of the term beneficial owner as used in double tax treaties. The guidance is aligned with the OECD commentary. For a copy of the government's announcement, which includes a link to the decree, please go to our website or app. In Vietnam, the law has been changed effective the 1st of July 2020 to extend VAT to apply to transactions with consumers involving inbound digital services and goods sold under e-commerce business models. A VAT collection obligation will be imposed on banks and other payment facilitators. In addition, the non-resident suppliers will be required to register for VAT if their suppliers exceed the registration threshold. Commentators have noted that there will need to be some coordination between the two collection systems to avoid double counting. The European Court of Justice has decided a VAT case concerning the University of Cambridge, a not-for-profit educational establishment. The university makes both VAT exempt and VAT taxable supplies. Its educational services are VAT exempt. Its commercial research, publication sales, consultancy services, accommodation services, etc. are VAT taxable. The university receives donations and endowments, which are placed into a fund and invested. The income from the fund is used to finance all of the university's activities. The university pays fees for the management of the fund. The issue in the case was whether the university could claim an input tax credit for the VAT charged on those fund management fees. The court decided that no, the university cannot claim an input tax credit. It gave two reasons. Firstly, the court said that the receipt of donations and endowments is a non-economic activity, and therefore it falls outside the scope of VAT. and the investment of such donations and endowments must also be treated as a non-economic activity. And accordingly, the VAT paid on the investment management fees does not qualify for an input tax credit. The second reason is that the investment management fees are not incorporated in the price of a particular output transaction and cannot be considered to be part of the university's overheads. I must say that the court's discussion of overheads is difficult to follow. For a copy of this case, please go to our website or app. In the EU, the new system on tax dispute resolution mechanisms to resolve double tax disputes between member states began operation on the 1st of July. This marks a significant improvement on the previous scenario, where taxpayers were limited to the MAP provision in double tax treaties, generally without mandatory binding arbitration, or the EU's Arbitration Convention, which has a number of shortcomings. The new system is set out in Directive 2017/1852, which was approved in October 2017. The new system applies to complaints submitted on or after the 1st of July 2019 and which relate to disputes concerning income or capital derived in a tax year commencing on or after the 1st of January 2018. However, despite these two official start dates, the competent authorities can agree to extend the new system to complaints submitted earlier and/or to earlier tax years. The scope of the new system is described in Article 1 of the directive. This directive lays down rules on a mechanism to resolve disputes between member states when those disputes arise from the interpretation and application of agreements and conventions that provide for the elimination of double taxation of income and, where applicable, capital. For a copy of the European Commission's press release on the new system, and for a copy of Directive 2017/1852, please go to our website or app. And the European Commission has published the 2019 edition of Taxation Trends in the European Union, which provides a detailed statistical and economic analysis of the tax systems of the 28 EU member states, plus Iceland and Norway. For your copy, please go to our website or app. In France, the tax authorities have issued guidance in regard to the new GAR provision, which was introduced as part of the transposition of the EU's ATAD 1. The new provision applies to tax years commencing on or after the 1st of January 2019. For a copy of the guidance, please go to our website or app. In Luxembourg, the tax authorities have issued guidance on the operation of the patent box regime, which was introduced in 2018. For a copy of this guidance, please go to our website or app. In the Netherlands, the government has introduced into Parliament a bill to enact the hybrid mismatch rules in ATAD 2. The provisions in the bill will apply generally from the 1st of January 2020 and from the 1st of January 2022 for reverse hybrids. Commentators have said that the bill will cause many multinationals to unwind their CV-BV structures. For a copy of the bill and related documents, please go to our website or app. Also in the Netherlands, the government has published the final version of the revised policy for rulings with an international character. The final version is almost the same as the draft which was released in April. The revised policy became effective on the 1st of July. In Norway, the government has announced that the VAT rate for electronic publications will be 0%, the same rate as for printed books. This change is effective the 1st of July 2019. Also in Norway, the government has issued for public comment a consultation paper in regard to a proposal to remove the existing VAT exemption for imports of low-value goods, effective the 1st of January 2020. According to the paper, the government proposes to do this by introducing new legislation where sellers and online marketplaces will be liable for VAT on cross-border sales of low-value goods to final consumers in Norway. Public comments are requested by the 5th of August. For a copy of this paper, please go to our website or app. In Poland, the government has deferred to the 31st of December 2019 the introduction of a key part of the country's withholding tax reform. That aspect is the obligation for payers to withhold tax at the domestic rate of 19% or 20%, regardless of relief under a double tax treaty or EU directives. In the UK, the upper tribunal has decided a VAT case in regard to a promotional offer of 3 food items for £10 with free wine. As the food items are 0 rated, but the wine is subject to standard rate VAT, the issue in the case was whether the £10 should be apportioned between the food and wine, or whether the wine truly was supplied for free. The tribunal held that the £10 should be apportioned between the food and wine. For a copy of this case, please go to our website or app. Zambia has again postponed the start date for its sales tax, which will replace the country's VAT. The original start date was the 1st of April. It was then postponed to the 1st of July, and now it's been postponed to the 1st of September. In Armenia, the government's proposed corporate income tax law amendments have been enacted into law. There are 2 key changes. The corporate income tax rate will be reduced from 20% to 18%, and the dividend withholding tax rate will be reduced from 10% to 5%. Both changes will be effective the 1st of January 2020. Brazil and the OECD have organised a conference in Brasilia on the 11th of July to highlight an important milestone reached in the joint transfer pricing project between OECD and the Brazilian tax authorities, which focused on analysing the existing Brazilian transfer pricing rules and comparing them to the international standard represented by the OECD transfer pricing guidelines. For information about the conference, please go to our website or app. In Canada, Ontario's Court of Appeal has decided by a 4-to-1 majority that the carbon tax legislation, the Greenhouse Gas Pollution Pricing Act, which was passed by Canada's Parliament, is constitutional. This follows a similar decision by a 3-to-2 majority by the Saskatchewan Court of Appeal in May. That Saskatchewan case has been appealed to the Canadian Supreme Court, with the hearing scheduled for the 5th of December. For a copy of this Ontario Court of Appeal case, please go to our website or app. In Chile, the tax authorities have issued guidance in regard to triggering of the most favoured nation clauses in a number of Chile's double tax treaties. The treaty with France in regard to interest and royalties. The treaty with Sweden also in regard to interest and royalties. And the treaty with Argentina in regard to royalties. The guidance also discusses the most favoured nation clauses in Chile's treaties with Australia and Uruguay. For a copy of the guidance, please go to our website or app. In Colombia, the government has issued a decree in regard to the operation of the thin cap rules which apply from the 1st of January 2019. The decree provides definitions of various terms as well as setting out the calculation procedures. For a copy of the decree, please go to our website or app. In the US, the IRS has released a series of questions and answers in regard to the deemed repatriation rules under Section 965. For the link to this Q&A guidance, please go to our website or app. Also in the US, the general high tax exception in the GILTI proposed regulations is generating lots of commentary. I've noted one particularly interesting point. A number of commentators have said that making the election for the general high tax exception could lead to a higher US tax bill, and so obviously care should be taken before deciding to make the election. The possible higher US tax bill would come from the fact that by excluding CFCs with high foreign tax, you would also be excluding the foreign tax credits from that high foreign tax. That might leave the group with GILTI income derived by CFCs which don't qualify for the high tax exception without the shelter of high foreign tax credits. And now for this week's treaty developments. We've had 2 treaties signed and 2 protocols enter into force. I have 2 articles for you this week. The first article is called, Are We There Yet? International Implementation of Hybrid Mismatch Rules. It's written by Mark Brabazon and it's published in the IBFD's Bulletin for International Taxation. According to the author, this article provides an overview of hybrid mismatch recommendations under Action 2 of the OECD G20 BEPS project and the corresponding requirements under EU ATAD 2, a snapshot of their international implementation to date, and a preliminary comparison of hybrid mismatch legislation in specific countries. Those specific countries are Australia, New Zealand, the UK, and the US. The article includes 2 very informative tables. The first is a summary of national responses which have been taken in OECD member countries in regard to each of the recommendations in the Action 2 final report. The data has been sourced from the IBFD's BEPS Country Monitor. And the second is an excellent high-level comparison of the implementation of hybrid mismatch rules in those 4 specific countries and the EU in the form of ATAD 2. This comparison includes statutory references for each of the 4 countries and references to the specific ATAD 2 provisions. The second article is called Digitalisation in a Broader Tax Perspective. It's written by Steph Van Wagel and it's published in Kluwer's Intertax Journal. This article discusses three major effects of digitalisation on taxation. The first, as you would expect, is the effect on corporate income tax avoidance and international allocation of taxing rights. That effect is the focus of the current digitalisation project being undertaken by the OECD's inclusive framework. The second is as a potential solution to the so-called tax gap, the difference between the tax which should be collected in a particular country according to its tax law and the tax that is actually collected there. And the third is the impact of digitalisation on the so-called shrinking middle class. In regard to the second of these effects, a potential solution to the tax gap, the author writes this: based on the OECD's figures, the cost of BEPS is approximately 0.36 to 0.91% of total tax revenue in OECD countries. Measured against GDP, lost revenue as a result of BEPS is 0.12 to 0.342%. On the other hand, the tax gap is enormous. A study published in December 2018 in the Journal of Money Laundering Control researched the tax gap in 35 countries, and its findings reflect tax gaps varying from 13.5% of GDP in Italy to 1.7% in Luxembourg. It is understandable, but no less remarkable, that the international attention and energy devoted to BEPS is so disproportionate to its relative monetary importance, and that there is so little attention to the far more significant portion of the tax gap caused by the informal economy. Digitalisation offers an opportunity of significant reduction of the tax gap. The informal economy is characterised, amongst other things, by cash settlement of transactions taking place in that economy. As society increasingly turns cashless, detection risk of tax fraud ought to increase. Well, that's the way it is this Friday, the 5th of July, 2019. I'm Steve Towers. Have a great weekend.